Well, in John Farrow's honor, I'm going to start with jobless claims, 218,000. That's bang on what had been forecast. And continuing claims rise to 1,927,000. Last week, it was 1,840,000. So a slight rise in jobless claims after last week's fallback. Now, we have to caution that a lot of economists are noting this could be distorted by the fact that last week, or the week in these surveys, is Thanksgiving. And so we may see some unusual numbers for that week, but it doesn't suggest that we're having a huge situation with a lot of layoffs and things like that. Personal income up 0.2% after 0.3 last month. Spending up 0.2. Both of those are exactly what was forecast. 0.7 personal spending in the month of September. The deflator for PCE headline is flat, 0.0 after 0.4, which drops the PCE deflator on a year-over-year basis to 3%. That's obviously the lowest since the pandemic began. Core comes in at 0.2, which is what was forecast, down from 0.3 last month, pushes us down to 3.5%. So basically, Lisa, what we've seen is what was expected. Economists forecast jobless claims, spending, income, and inflation pretty much exactly on the nose.
Mike, when we take a look at this sort of ongoing disinflation and steady labor market, how much can you pair this with what we saw from the Beige Book yesterday, and the sense that anecdotally you are seeing a tightening of the labor market, but it may not be happening in the same kind of way as mass layoffs?
Yeah, what we saw in the Beige Book was, though, the first indication that companies are starting to say they feel okay with doing some layoffs or letting jobs go via attrition. That's a new development, because up to this point, everybody's been trying to hire as many people as they can, or at least hold on to them. So we'll have to see if that gains momentum. It wasn't mentioned as a major trend in the report, just something that had changed. Claims at 218, still very low. Last week was revised up to 211 from 209. So we're not seeing a major trend in layoffs, but we do see more people on continuing claims for a longer period of time. So some indication of softness in the labor market. Now we'll see what happens with income and spending up 0.2. It's still strong, but not hugely so, not like it was in prior months. So we'll see how whether that rebounds or not, and how companies react to that.
We're about 42 minutes away from hearing from New York Fed President John Williams on Friday. Tomorrow, we're going to be hearing from Fed Chair Jay Powell. Citigroup's Andrew Hollenhorst posting that he does have an opportunity to push back on the idea that this disinflation will necessarily lead to rate cuts in the first half of next year by the Federal Reserve, as the market seems to be pricing in. Based on what we have heard, do you agree with Citigroup's assessment that it seems unlikely that he would come out and try to jawbone the market one way or another and push back on rate-cutting claims?
I don't think he will necessarily push back on rate-cutting claims. If he gets asked about it, he would say, we're not talking about that yet. They're still going to be in that mode. I think Tom Barkin put it well yesterday. He said if inflation continues to come down, great, and he's certainly not going to push for a rate increase if it does. But if it doesn't, they should leave it on the table, which is, I think, where the Fed wants to be at this point, because they don't want the markets going too far. The interesting thing is, nobody is arguing with the idea that the Fed is going to cut rates in 2024. The Fed said it was going to cut rates in 2024 in the September dot plot. We'll see what they do on December 13th, but it's really a question of how fast inflation comes down. And we're not really talking about, Bill Ackman said the first quarter, we're not really talking about whether or not somebody is predicting this or that time period for the Fed. Look at what inflation is and how fast that comes down, and that'll give you a better idea of when the Fed's going to be thinking about it.
What are you looking at when you parse through these numbers that stands out to you?
A couple of the most interesting things. Wages and salaries in October are the lowest in quite some time, just up 0.1% after many months of 0.5% and 0.4%. So we are finally seeing a deceleration. Of course, standard caveat, 1 month does not make necessarily a trend, but this is what the Fed has been expecting. So it will be interesting to see if that continues, because the real drop was in private industries and in manufacturing, areas where people get paid more money. Those have fallen. Manufacturing was flat, and private industries just up 0.1. Both were up 0.5% in prior months.
Is this basically the playbook, that this is sort of the first signs of a squeeze that then kind of get carried out in more aggressive actions like cuts? Is this sort of how it typically happens, or is there still nothing typical about this cycle?
Well, there's nothing typical about this cycle, but if we are going to go into that kind of environment, this is how it would begin. It doesn't necessarily mean that we go down that slope all the way. For example, we've been talking quite a bit about whether or not Americans have exhausted their pandemic savings. Well, the savings rate went up in the last month to 3.8% from 3.7%. So there's still a lot of we don't know out there.